So I think the U.S. government is somewhat chasing the silver market right now. And so I think that's, again, what's going to set, some sort of floor on the silver price moving forward and put a lot of upside pressure. Gold, to a lesser extent, yeah, the central banks will continue to buy more gold as we go deeper into economic issues around the world and fiat currency problems. But I almost think if we do have a new Fed chair come in and we do have a repositioning where we go back more into quantitative easing, you're going to see a temporary boost in the value of the dollar. You're going to see a temporary boost in GDP output. Of course, that will cause more inflation long term, and it may be the final nail in the coffin of this fiat currencies, which will eventually lead to on Friday, we had big drops in both silver and gold. And according to what I find publicly, silver was down 36% on Friday. Intraday, meaning before the close, and it rose a little bit to be down 31%. And last night when I was looking at the statistics for the trading, and I looked at how much contract activity there was over 300,000 contracts of 5,000 ounce silver. So on Friday, there was 1.5 billion ounces of paper silver traded. Annual output of silver from the mines in the marketplace is 819 million ounces. So it was about a 1.7, 1.8x dump basically a dump onto the silver derivative market, yearly annual production, which I've never seen that much in any given day. I mean, there's a lot of activity in these markets. They're leveraged derivative markets, but that's a lot. And in gold, it was about half of annual production was done in a day. And so both gold and silver had a really bad down day. And it's interesting as you go through and look at it, there are circuit breakers. And I did look this up because there have been some comments by different analysts. And I've been talking to it with other analysts that I know as well that analyze these markets. And according to the CME Group, and I just downloaded this from their website, silver futures have a special price fluctuation limit and daily price limits of 10%. So I anticipate that as I'm reading, from the CME Group's website, I mean, it looks as though that they have a circuit breaker. They call it the circuit breaker and daily price limit changes for CBOT interest rate, FX, and metals futures and options. And so that includes the futures prices, which determine, the prices that we see every day on the spot market. Those are determined on the futures market here in the US. And it's supposed to be 10%. So if I'm reading correctly, the summary of what happened to the market, it was down 31% today, but the circuit breaker should have tripped at 10%. Now, they don't tell us in this Excel file that you can download or the table that's online that's, it just says 10% a dynamically calculated reference price daily, and it's a daily price limit. So that would seem to indicate that after about 10%, they would have stopped trading. Much like you have a downside circuit breaker on the stock market. If Apple stock goes down a certain percentage, or if you see an index go down a certain percentage, a lot of times the stock market will stop trading to stop a slide. And the reason that is, Elijah, is because on all of these markets, whether the stock market or Forex or metals, futures, and commodities, there are algorithmic trading programs developed by all the main brokerage houses and banks and big participants, market makers. So that, when you have some sort of price decline or increase, a lot of times those algorithms, those software programs that run on the trading platforms will make a move based on that. So for example, if silver's falling 5%, a lot of times that triggers somebody else selling, especially if they were long, because they don't want to take a loss. And that happens in a lot of these markets. And that is why the circuit breakers were developed originally for the stock market years ago and now exist for the commodities markets, is that, when you have a big free fall in price, these circuit breakers would stop it, because these are leverage markets. You have a lot of small players, but you also have big concentrated players in the market. And if these big concentrated players or the bigger players are using these automated trading programs that all get triggered to one side, you could end up really killing off a position of a smaller player. And so on June 2nd of 2025, the CME Group had instituted these new circuit breaker and daily price limit changes. And apparently it's 10% in silver. And if I look at gold, the gold is, well, it doesn't have one. There's one in silver. I don't see one for gold or micro gold. If I look at both silver and micro silver, it's 10%, and E-mini silver, and on the futures only, not on the options. You also have it on copper futures. You have it on aluminum futures. Oh, you do have it on gold futures, and it's all 10%.
Silver's collapse revealed a long-standing imbalance between paper markets and physical metal. Futures contracts representing over 1 billion ounces changed hands in hours, while less than 1% of those contracts ever result in physical delivery. Registered silver inventories, the metal actually available for settlement, remain limited. Physical supply did not suddenly increase, nor did industrial demand collapse. This was price discovery driven almost entirely by derivatives. The disconnect highlights a system where price is dictated by leverage and positioning, not by the metal moving out of the ground.
So pretty much across the board on metals, 10% on the major traded items. Why that wasn't triggered in silver, I don't know. I think gold came under that. It wasn't 10%. Silver, I think it was. So that's the question. And then what caused it? We were talking before the show what caused it. The only news item that people are quoting and saying could have caused that cascade of sells, maybe it's a human that started it and maybe it was a computer, we don't know, was that Trump has nominated Warsh as the next Fed chairman, and that the Department of Justice is doing an investigation into Powell. And so somebody's trying to block that nomination for now until the investigation of Powell is done. And that's a little bit of news, but it's not like it's actually occurred. They haven't confirmed a new chairman. The chairman hasn't come on and stated that he's taking any given direction. Also, at the most recent Fed meeting, they're holding interest rates steady. There's expected to be some interest rate drops later in the year, not now. And the Fed has stated that given the information they're looking at, that they're not wanting to make a change in the immediate future. They want to see how employment and inflation goes, specifically employment. Now, if you look at ADP's employment numbers for this week, there was only 22,000 new jobs created. We'll get the big report, the government non-farm payroll, or what they're now calling just the jobs report later on Friday. It typically comes out Friday. But as long as positive jobs are created, then I don't see a reason why that would have caused, and it's only 2250. That would not cause gold to move either way, really, unless it's a major surprise. And further, if we look further into economic with the United States, last week I was looking at FactSet in terms of Q4 earnings for U.S. corporations, and with only 13% of companies reporting of the S&P 500. 70% of those 13% of companies, so roughly 9 to 10, had a bit reporting earnings surprises, and from what they thought that they would have. Those were led by the Magnificent Seven, which had about 21% earnings of the S&P 500. The other 493 companies were averaging about 4%. But we still have a lot of data to come out from Q4. But it looks as though we're going to have a positive GDP print. Unless the rest of the market just is totally tanked, which we're not expecting. So positive GDP print, modest jobs numbers, not a big, surprise on jobs numbers, not a big crash on jobs numbers. The 10-year bond is still elevated above 4% last time I checked, the Treasury. So and the DXY had made a slight upward move, but it's not anything to write home about. It had reversed its fall slightly, a little bit of positive movement from the dollar in the DXY index. So, I'm looking at this going, there was mixed data, and could that have caused somebody to want to go short gold or silver a bit? Sure. But would that explain the biggest price, the dollar amount fall in silver in U.S. history since, 1974 and the Commodities Act and the way that we trade silver now, not as money, but as a commodity, as an asset? No. Should it have caused, almost a $700 free fall price in gold? No. Gold was a tad less surprising because it was under 10%, and we had a massive run up in gold for 2 years. So that I could just explain by saying maybe somebody big came in and dumped a bunch of gold futures on the market. But in reality, to see that happen to silver at 31% was, to me, it's not explainable in a one-day drop. And when you look at the volumes of paper that were traded, it really looks as though there was some short covering on the futures that needed to happen. And if you look at when options expiration was at the same time on the COMEX, it was the 27th, just a few days before. So what I'm assuming was once the upside, the long options, had been met and expired, that offered an opportunity to reset the board on the price via the futures. Okay, and so I think that there were short covering. Now, if you look at the banker participation report, the most recent one from the CFTC on who trades the gold and silver options, U.S. banks are net short on gold. U.S. banks are net long by about 1,000 contracts on silver. The bullion banks are actually short on silver now, or the global banks. So you can say, maybe it was the global banks mostly that had this short positioning that needed to short cover. And they probably did, because silver had run up so far from the low 20s to about $121 in the span of less than 2 years, really about a year to year and a half in that time frame, that it is quite possible somebody needed, to get out of those short positions. There's some short covering needed to occur. And so I think it more had to do not with supply and demand, not because we had found a bunch of more silver, not because of a Fed announcement or GDP or labor or economic reasons. It simply was the fact that whoever was in short silver didn't want to be short silver any longer, and there was a slide in the silver price and in the gold price to cover shorts right after options expiration. And I would even go far, if I'm stepping out on a branch and pure speculation, if you look at the timing of this, we had that massive run up, those options had expired. Maybe somebody made their money on options and decided to short it and bring it back down and make money on the other side in shorts. It looks to me more like financial engineering makes more sense. And the fact that the circuit breaker wasn't tripped 10% in a day, there's questions for CME Group and the CFTC, the regulator, as to why that occurred and why that 10%, based on the table I'm looking at, it's very basic 10% per day. It doesn't give any other explanation as to, was that 10% per day per trader or other provisions that needed to be met. So I think I think that the CME Group has some explaining to do, and that the CFTC needs to be the one asking those questions.
Modern futures markets are designed with safeguards to prevent cascading algorithmic sell-offs. Silver futures, like other major commodities, are supposed to trigger daily price limits near 10%. Yet this collapse pushed far beyond that threshold. Whether due to exemptions, reference pricing mechanics, or structural loopholes, the safeguards failed to stop the decline. In leveraged markets dominated by automated trading, once selling begins, algorithms amplify momentum. What followed resembled a controlled demolition rather than an orderly correction, raising serious questions about regulatory oversight and market transparency.
I do, because if you look at the nature of the market, and this is something, I have a masterclass on my homepage on YouTube, the Freedom Report. I did a 3-part series talking about the precious metals from mining out of the ground to final, bars and price derivatives and everything in between. It's a 3-part series. And in there, I talk about the fact that only about 1/2% of given daily volume on these derivative markets are actually physically traded, or physically what they call delivered. And we had to use a couple terms here. Delivery just means it stays in the warehouse, but we're changing ownership. Okay, and that just means we're changing parties. And then loadouts when you actually take it off the exchange. And then so where it's actually gone. And there has been some less silver available overall in the liquid trade, and that goes to the third term, which is registered versus eligible. So just, going back to that, I know we used to talk about this on your show all the time. Registered inventories are what you can actually trade physically. So if somebody stands for delivery on gold or silver or any commodity, it has to sit in registered. If it's ineligible, that's really just storing it on a COMEX depository, but not specifically for COMEX trade. It could be privately owned. And so the amount of liquid silver has gone down in recent weeks from 119 million ounces to 110. But the overall amount of silver that at some point could be put up for trade really hasn't gone down on all these COMEX approved depositories. So I'm not seeing the silver just disappear physically. And so this is really derivative price trading. And, I think if you look at the massive run-ups, there needed, and I've been saying for a month, there needed to be a pullback. Because I've never in my life, in the commodities markets, or was specifically gold and silver, we kind of saw something in oil a few years ago. But in gold and silver, I've never seen a run-up like that, uninterrupted in that price before we had a pretty big pullback. So if from technical terms, you could just say, because it's derivative trading and technical analysis matters, because it's what the derivatives trade on. They don't deliver more than 0.5% of these contracts in physical every day. And they certainly aren't loading it out and taking it away. So it's really gambling and betting on where the price should go, much like a lot of the futures market is in other commodities. And so it's really just positioning on where people think it's going to, it's a bet. They're putting money on black, they're putting money on red, right? The effect that this is going to have, however, is the fact that the circuit breaker didn't hit is going to cause concern for people either trading the derivatives or buying gold and silver. Let's talk about from a stacker perspective for a minute. There's a huge amount of buying Friday, Saturday, Sunday, Monday, because I run a big gold and silver metals dealer. I went this Saturday and talked to a lot of local dealers in Dallas-Fort Worth. I talked to my friends in other states that have dealerships, and they're selling a ton. And the reason they're selling a ton is because a lot of stackers are saying, silver went to 121, it's down mid-70s to low 80s. I'm going to go buy because I think it's going to go back. So if you're a long-term optimist or bull on gold and silver, you might have been buying this weekend. But if you're a derivatives trader or a new person to the market, you may look at that and say, ooh, I don't know if I want to be in that market. Look at the volatility. I mean, look at what happens to Bitcoin or a meme stock when you have these huge fluctuations. A lot of people began to get shaken out and say, I don't want to participate in that market. So I think that there's going to be an overhang. I did an episode of my channel Friday about 3 p.m. Central, near the close of trading where I said, it's quite possible there's an overhang on these markets for a while and the prices don't reach where they were for a while. And that has to do with the size and length of the move on the technical chart. And then from a human psychology standpoint, people just may not want to play in those volatile markets. I did say 4 or 5 years ago, because gold and silver have historically been money for 5,000 years and still in Article 1, Section 10 of the Constitution, they still are. And that they have a monetary component across the world throughout history in many cultures that I'm long-term bullish on the metals. And I think that they'll become very volatile as we go further into what I think is the end of the dollar fiat currency era. And that the metals are going to be very violently traded because you're going to get more interest in them. And if you add on top of that silver specifically, how much it's used industrially across the board, and how most silver ounces are not recovered every year in scrap, that the amount of free-floating silver we have is coming down every year because of lack of mine output to demand, that we're going to reach some sort of crisis point in silver where, silver is going to be extremely expensive or very difficult, if impossible, to obtain. I don't know that we're quite at that point yet, but we're probably getting closer to it. And so I think silver in particular is going to move higher as a percentage amount than gold the next 5 years. But it may make time for those prices to get bid back up because, again, it's a derivative trading. Think if you were along and you just experienced a 31% drop and maybe lost part or all of your position, are you going to go bid that up long again? And then within the market, who were the ones doing it? Certainly in silver, the foreign banks held the shorts, did their incentive to get those covered. But did they initiate it? Who was in there? And the size of the move indicates it wasn't a small trader. It was either a large trader that kicked off a bunch of the algos and they all followed suit, or it was a concentration of traders that all came in on the same day. And then my question for the market is, how often does that happen? And why? And if there's not news precluding it, then it had more to do with covering positions in the futures and on. I mean, that's really the only explanation I got. So the rest of the world's going to see it. It's going to cause some consternation. It may cause a loss of confidence for some people in the Western commodities markets, perhaps, as well. And so the long term is it may push more trade to Shanghai and to some of these other markets as well.
Despite speculation, macroeconomic data offers no convincing trigger. Interest rates remained unchanged. Employment data was modest, but not alarming. Corporate earnings surprised to the upside, and GDP growth expectations remained positive. The dollar strengthened slightly, but not enough to justify historic metal losses. No confirmed central bank shift occurred. In short, fundamentals didn't explain the move. When markets react violently without a corresponding macro shock, the explanation usually lies in positioning, leverage, and timing, not headlines.
Yeah, the Trump administration said sometime late summer they were committing $4 billion to silver. Some of that was buying silver, some of it was infrastructure. If you look at the mining glut that we have now, refining glut, the refiners in the U.S. are basically maxed out on producing silver, and they're refusing business to reprocess scrapped silver and doré bars from mines and things, which is not great because we need as much silver as we can get given the mine output shortage. That, a lot of that refinement's going to have to go around the world. So you're going to see some silver move around the world to get refined, and refining costs are probably going to go up a fair amount. So there are going to be issues with fulfilling silver orders. And I think that's why it's become a strategic mineral. I think the U.S. government probably waited 10 years too long to declare that, because it takes about 7 to 10 years to get all that infrastructure permitted, built, and in place. So I think the U.S. government is somewhat chasing the silver market right now. And so I think that's, again, what's going to set, some sort of floor on the silver price moving forward and put a lot of upside pressure. Gold, to a lesser extent, yeah, the central banks will continue to buy more gold as we go deeper into economic issues around the world and fiat currency problems. But I almost think if we do have a new Fed chair come in and we do have a repositioning where where we go back more into quantitative easing, you're going to see a temporary boost in the value of the dollar. You're going to see a temporary boost in GDP output. Of course, that will cause more inflation long term, and it may be the final nail in the coffin of this fiat currencies, which will eventually lead to a panic and then back into gold and silver. So tying all this together to an earlier question, I think that the gold and silver markets are going to be more volatile going forward for all the reasons we just talked about. Demand, mining output, refining capacity, massive money printing, not only in the dollar, but in all worldwide currencies, and the oncoming issues with sovereign debt across the world. There's going to be a lot of interest in gold and silver, and I think the volatility in prices is going to continue. And I don't think this will even maybe be the worst day in gold and silver that we see going forward. We may see more of these days, or in the same vein of double-digit price drops, maybe even 20-25%. It wouldn't surprise me.
The timing points directly to futures and options mechanics. Just days after major options expirations, downside pressure intensified. Once upside exposure expired, futures markets were free to reset price levels. Large short positions, particularly among global bullion banks, likely used the opportunity to cover risk or flip positioning. This wasn't about mining output or demand destruction. It was financial engineering. A massive, rapid repricing allowed positions to be cleared, losses minimized, and new trades established at lower levels.
Yeah, I mean, if you're long-term stacking, I don't think the fundamental reasons why you do that have really changed. And, that's what I tell people is don't worry too much about the price movements. People got mad when silver was stuck in the low to mid 20s for seemingly years after the potential silver squeeze in early 2021. And then look at what's happened to it now. So patient investors who have done their research ahead of time and have a bit of time horizon to invest will generally do really well in the precious metals. I mean, gold from 2000 to 2020, mid 2024, followed CPI inflation pretty closely, not day by day, but overall on an average, if you look at a chart. In mid 2024, beginning to middle of the summer, gold separated from the dollar. It separated from inflation. It separated from other commodities. And I think, Elijah, what we're seeing in gold is it's beginning to become, if we look at Basel III and central bank buying, it's becoming the currency of choice. And I think other commodities and the dollar are now considered to be priced in gold. Gold has sort of resumed or reclaimed its title as king of the heap in terms of monetary asset. That's very clear, both in official stance by central banks, their purchasing, and now evaluations. Silver is kind of splitting off and saying, I'm so important to the world that as a commodity that I could reach potentially any price, because when you have so much demand for silver to run the world, to run electronics, EVs, solar, military, medical, it's used everywhere, and you have such a concentrated time, 5, 6, 7 years where we haven't mined enough, and getting new primary silver mines on, there aren't a ton in the world. It's a byproduct. So silver price is very sensitive to being a byproduct of other mines and other factors which have nothing to do with silver specifically. I think silver is going to be much more volatile, but much more promising in the long term in terms of value. So if you can stand the price fluctuations on the market, I think you're going to do okay in either one. I invest in both for different reasons, and I think they're splitting. Silver's becoming more volatile, industrial driven. Gold is becoming more the world reserve currencies. We get into financial issues, and to a lesser extent, silver's taking some of that monetary demand as well. But right now, I think it's mostly industrial issues which are driving, silver's price.
One note that, some people are concerned about that 10 or 15 year period, right, between 2011 to kind of just 2025, right, when silver didn't, if you bought at the high in 2011, you wouldn't have been made even until 2025. So your perspective on that, do you anticipate kind of a lost decade to happen, or is this environment fundamentally different from what happened then?
No, I don't see a lost decade because of the problems we've been talking about. We're closer to the fiat currencies blowing up. We're closer to debt collapses when you look at history. Even though we'll have GDP surprise for Q4 2025, they're having to ease for a reason. Anytime you get anywhere between 4 and 7% interest rates on sovereign debt like we have right now on the 10-year treasury, which is really the benchmark for most people. You can talk 20 and 30, but 10 years is the benchmark. Then you start having a problem paying for those carrying costs of that debt out of tax receipts. And we're seeing taxes being introduced at the local and state level all over the place, and are they going to increase federally? That's what you're going to start looking for going forward. And with the, if you look at real unemployment, I think it's somewhere around 20 to 25%. When you look at labor force participation, who wants to work, that never recovered post, the 2008, 2009, 10, 11 Great Recession. So all of the monetary and fiscal moves made by the U.S. government and the governments around the world haven't fixed the issues. So I've come on your program and talked about this for years, and I've been writing and talking about this now for 17 years. I don't fundamentally see any change to the positive in terms of economics. So, despite what happens on the goofy derivative markets with gold and silver, those are all short-term things. The long term is still bullish up on gold and silver for all of those reasons. And like I said, if you can stand the oncoming volatility, but what will be interesting is there will be a point at which gold and silver are more priced for their physical supply and demand. They're not right now. People made the mistake over the last couple of months of saying that they thought that the Shanghai market and other factors had released gold and silver to be valued per their global supply and demand, physical supply and demand. Friday was a reminder that the derivative markets still rule the roost on pricing. And, the derivative markets are a little goofy, but we'll eventually get to the point when we get into deeper fiscal problems and deeper industrial shortages of silver where that matters less. And I think the last 2 years were an indication of the future. The last 2 years were gold and silver repriced more closer to where they should be. I don't think they're done with that yet. Because fundamentals haven't changed economically, and with the fundamentals of supply and demand, the metals, I think we're going to have another, big boom, in my opinion. But you'll have volatility along the way. And, until the debt problems, the fiscal problems around the world are resolved, and until geopolitical concerns reduce, in other words, until the risk environment comes back to what you would see more normal on a worldwide basis, I don't think you'll stop seeing elevated gold and silver prices.
Short-term chaos doesn't erase long-term realities. Central banks continue accumulating gold as trust in fiat currencies erodes. Silver faces tightening industrial supply amid rising demand from energy, technology, and defense sectors. Refining bottlenecks and declining mine output add pressure beneath the surface. Volatility is the price of transition. Traders may struggle, but long-term holders understand this pattern. Markets driven by leverage will remain unstable, but when physical scarcity reasserts itself, pricing power eventually shifts back to the metal itself.